Investing in non-public companies, also known as private companies, is a significant aspect of the venture capital industry. Venture capitalists, VCs, provide funding to early-stage or high-growth startups in exchange for an equity stake in the company. This form of investment is often considered riskier than investing in public companies but can yield substantial returns if successful. Here's a detailed overview of investing in non-public companies. Investment process. Sourcing. Venture capitalists actively search for investment opportunities. They rely on their network, industry connections, referrals, and even pitch events to identify promising startups. Due diligence. Once a potential investment opportunity is identified, VCs conduct thorough due diligence. This involves evaluating the startup's business model, market potential, competitive landscape, financials, team expertise, and other relevant factors. Term sheet negotiation. If the due diligence process is satisfactory, the VC and the startup negotiate a term sheet. The term sheet outlines the key terms and conditions of the investment, including the amount invested, ownership stake, governance rights, liquidation preferences, and other terms. Investment. Once the term sheet is agreed upon, legal documentation is prepared, and funds are transferred to the startup in exchange for equity. Investment stages. Seed stage. Investments made at the seed stage are typically the earliest and riskiest. Startups at this stage often have just an idea or early product prototype. VCs provide seed capital to help fund product development, market validation, and early growth. Early stage. At this stage, startups have typically developed a minimum viable product, MVP, and have some initial market traction. VCs invest to support further product development, scale operations, and expand market reach. Growth stage. Startups at the growth stage have proven market acceptance, revenue generation, and are scaling rapidly. VCs invest larger amounts to fuel expansion, market dominance, and potential international expansion. Investment strategies. Industry focus. VCs may specialize in specific industries, such as technology, healthcare, clean energy, or consumer goods. This specialization allows them to leverage their domain expertise, network, and experience to identify and support high-potential startups. Geographical focus. Some VCs focus on specific geographical regions or countries. They may have better access to local startup ecosystems, government incentives, and cultural understanding, which can enhance their investment decision-making process. Portfolio diversification. VCs often invest in a diversified portfolio of startups to mitigate risk. By spreading investments across multiple companies, they aim to increase the likelihood of having a successful investment that can offset any potential losses. Value addition. Active involvement. VCs often take an active role in the companies they invest in. They provide guidance, strategic advice, and industry connections to help startups grow. They may also offer operational support, including recruiting key talent, refining business models, and establishing corporate governance. Network access. Venture capitalists possess extensive networks of entrepreneurs, industry experts, and potential customers. They leverage these networks to connect startups with valuable resources, partnerships, and business development opportunities. Follow-on funding. As startups progress and require additional capital in subsequent funding rounds, VCs may provide follow-on investments to support the company's growth and protect their initial investment. Risks and rewards. High risk. Investing in non-public companies carries inherent risks. Startups may fail due to market dynamics, competition, management challenges, or other factors. It's crucial for VCs to conduct thorough due diligence and manage their investment portfolio actively. Potential rewards. Despite the risks, successful investments in non-public companies can yield substantial returns. VCs aim to identify high-growth startups and secure significant equity stakes, which can generate substantial profits upon exit through acquisitions, IPOs, or secondary market transactions. In summary, investing in non-public companies through venture capital involves sourcing, due diligence, negotiation, and investment stages. VCs play an active role in the growth of their portfolio companies, leveraging their expertise, networks, and resources to maximize the potential for success. While investing in non-public companies carries risks, it also offers the possibility of significant financial returns if the investments are successful.